Good evening, everyone, and welcome to our PANGEA Investment Manager Quarterly Update. Joining us this evening is Mr. Matt Sparling from FSI Management. Matt is the Director of Investor Relations at FSI and has really been incredible with the previous updates and quarterly conversations he's been having with us. And we'd like to welcome Matt to the call and ask him a few questions about how things are unfolding at FSI, what the management is thinking, how interest rates moving in the way that they have are impacting the business, if at all, and just to learn from him about what to expect in the coming quarters when it comes to FSI, the performance, and what clients should be keeping an eye on. With that, Matt, welcome to the call. I'd like to open this conversation with a conversation that took place in the House of Commons, the Standing Committee on Finance, just on Monday, April 25th. The Bank of Canada Governor Tiff Macklem said that Canada's key interest rate could go up another half percentage point or 50 basis points in June, just around the corner here, and in an attempt to wrestle inflation under control. I wanted to talk to you about the pipeline of opportunities that you're seeing at FSI, and given the aggressive interest rate environment, wondering how that pipeline of opportunities has changed, if at all.
Yeah, no, thanks, Declan. Yeah, you know what? It's been a good ride in the first quarter. We've had back-to-back record months with business. Our CIBC, which is a main contributor now, have had back-to-back record funding months with us. We're clipping it along about a 58% loan-to-value portfolio currently, which is, I think, near the lowest point that we've ever had. The company historically, our defaults continue to be almost non-existent due to a lot of, obviously, the prepaid. I think we only have a handful of deals that are currently past due but are being worked on, so we don't foresee any issues there. We have seen, on the A side, the rates have gone up. I think most of us with our mortgages on a variable have felt that a little bit, because I know I have. But the interest rates on the prime side, they don't impact us at all with the nature of business we're doing. Our rates are what they are. We price accordingly based on loan to value and location of the property. That hasn't changed in the last 5 years, and we don't anticipate it to. Some of the stats we are seeing, was out in the news earlier this week, is we're seeing a bit of a dip in the house market as far as pricing on the, I guess, more luxury real estate stuff that's north of, they're basically $4 million and up. They are seeing, I think it was a 13% drop in the average price. Our wheelhouse for what we do is generally house values are between about 4 to about $1 million, 1 million, 2. That's sort of our bread and butter range, and there has not been any decline in house values in that space that we basically dabble in. We don't get into the $4, $5, $6, $7 million home values with what we do. So we haven't been impacted there either at all. So overall, yeah, the fund, again, we still continue to a portfolio, which obviously gets our investors the 10% spread that they've got since inception. Things look very bright for us going forward. As I said, we've had back-to-back record months with fundings, and there's no signs of that slowing down either.
Matt, you're usually very good at answering these these types of questions by providing a really good 360 on the answer. I'd like to go a little bit deeper, if you don't mind, as you're driving there, and thank you again for safely doing so while you're on the call with us. We know that according to OFSI and their B20 mortgage qualifying rate, that insured and uninsured mortgage borrowers are qualified based on the contracted rate plus 2%, or currently at 5.25, whichever is higher. For a growing number of borrowers, however, that rate is now going to be higher than the 5.25% with interest rates continuing to rise. I wanted to tie that thought back into the FSI mortgage portfolio. And the question I have here, and I have a sense as to what you may share, but definitely always looking for insight that we're not aware of. The question I had is, what percentage of the FSI mortgage portfolio would you say would be negatively impacted by the aggressively rising interest rates in the coming quarters? And specifically, where I want to take that question is that is the borrowers whose repayment capacity is further constrained by higher debt payments, as you've alluded to earlier, where you've seen your own variable rates changing and having a modest or some impact. Would love to hear your thoughts on that question.
Yep, for sure. The easiest way for me to answer that, I guess, in the grand scheme of things, is because of the loan. This is why the portfolio loan to value is so important for us in keeping it where it is, because most, especially B banks, and I'll get to CBC as well, as at a 65% or better loan to value, they will increase the TDS and GDS capacities for clients because of the loan to value of the loan, especially for self-employed, which obviously we do a lot of, because they have problems qualifying with the A banks. The B banks do give clients, B2B is one of the big ones that we deal with. They do give gracious TDS and GDS considerations when you're 65% or better on your loan to value of your home. The banks as well, and I'll talk specifically, obviously, CIBC, when we're refinancing their own people, again, 65 loan to value or greater, which is the majority of business we do with them, they do make the TDS and GDS exceptions, because the way they look at it is if they're able to pay a 10% interest rate on a second mortgage fund on top of their existing first with them, well, if we combine that second at a rate of whatever it is, 2.5%, 3.5%, whatever the client said it, well, if they can pay us at 10, they can certainly pay CIBC at a 2.5%, 3.5% interest rate. So the banks are more forgiving for their own clients. They will make exceptions, again, to the qualifying rules, and will absorb those mortgages back from us as long as the clients have rehab whatever mess that they originally did partake in. So that's why we do what we do as far as the loan to value. When we do the higher loan to value deals and put those in the fund and don't have individuals funded, those are the ones that have the teacher jobs, the lawyer jobs, the doctor jobs, the union jobs have been there for 20, 30 years. Those are the ones that will do the 70, maybe the odd 75 loan to value, because we know they're income qualifying, so that in 12 months, the reason why they're coming to us now is because their credit score is not good enough. It's not income-wise, it's credit score-wise. So again, those clients we're able to move back up to the B banks. So it's just a matter of if their credit score is at 620 and they need to be at 680, 12 months, we coach them, do this, do that, do this, don't do that. That's back in the qualifying with the banks as well. So this is why I always say is we're very careful with every single deal we put on our books. Because again, rate environment, that can change in a dime, which it has in the last couple of months. We have to have an exit strategy, and we know going into the deal, if the worst case scenario is obviously rate hikes and or the client doesn't rehab themselves, what's our exit strategy in 12 months? Worst case, they have to go here. Best case, they get to go here. And when you've got a portfolio with the loan to value that we have, it allows the flexibility that it allows us to get out of these mortgages in 12 months is imperative to keeping our books as clean as we do.
Thank you, Matt. I appreciate you saying as much as you did in as much detail as you did. You talked about the lending criteria. You talked about CIBC for one example. And I wondered to ask about this, given the significant rise in property values over the past few years, what can you tell us about any underwriting policy changes that have taken place at FSI, considering we want to protect on the downside and mitigate any risk?
Yeah, again, because our portfolio is low, so we use a lot of the underwriting and even the appraisal process now We actually have an inside guy that has been with us for a long. He's a realtor, licensed realtor. He's been with us a long time. We do use Crosstown, which is the most conservative appraisal companies in there. We actually had a deal we just did. We had Crosstown appraise the property. We knew the client was going to sell it and list it, but he needed the down payment for his future property, and this was a little bit more of an expensive home, but we had Crosstown do the appraisal, and again, very conservative. They sold the house the following week. They had it listed on the Tuesday. It sold firm on the Wednesday. It sold for $500,000 more than what Crosstown appraised it at. So between Crosstown doing a lot of our appraisals and then the stuff that's super loan to value, we use our in-house guy. He does the same thing that the appraisers do. We get pictures outside of the house, market comparables in the area, and we have him purposely shave 10% off what he thinks that house could or should sell for. So if it's $1 million property, he prices it at $900,000. So right now, day to day, deal by deal, we're monitoring. As I said, we can see, okay, generally speaking, when the government starts raising interest rates, the bank starts raising interest rates, what does that generally do? Which it is doing, it cools the rise of the average price of the house. So how do you mitigate this gap? Well, you make sure that when you're getting them appraised, you're extremely conservative. That way, even if we are light by 10%, well, if the market drops by 10%, well, we're sort of that where our appraiser said we were at. If that client now goes to sell that $1 million home and only gets $900,000, well, that's the price he gave us for it. So we're in line with and our lending criteria and loan to value. That's what it's calculated on. It's not calculated on a purchase and sale agreement. What do you tell us it's worth? And we do get purchase and sales where the appraisal comes in lighter than what the client paid for it. A house is only worth what someone's willing to pay. But regardless of what someone's willing to pay for it, what do the comps say it's worth? Well, the comps say it's worth this. Well, then that's what it's worth. Someone paid an extra $100,000 or $200,000 for it. That's their prerogative. But stats say this is what it's worth. So we're very mindful of that. Harry, one of my partners, does. Between me and him, we underwrite everything, but he literally underwrites every single file that comes through that. We pay very close attention to market conditions. Obviously, rising interest rates do have an impact on the housing market significantly. So that's something we monitor every single day.
I appreciate the conversation around Crosstown appraisal. We know them well, and the fact that you ask your in-house relationship to actually discount the value by up to a 10% spread speaks well to your risk management and your prudence in managing risk around the portfolio. You also mentioned earlier in this conversation around B lenders having a bit more flexibility in the latitude of the TDSR, GDSR ratios. And for the folks listening on the call who are aware of how mortgages work, they know those ratios that the banks generally underwrite by, the percentages to approve the mortgage amounts and the terms. So I wondered, with regards to your in-house underwriting, if FSI has a similar flexibility with the ratios based on LTV, loan to value.
No, so that's one thing we do not take that into account. What we look at is affordability, and obviously we're equity lenders. That's what we are. So we look at, generally speaking, any second mortgages, unless the clients have, both clients, like we're talking like two school teachers, incomes $120,000 each a year combined, and we look at it, okay, can they afford the first and second? Yeah, they can. We'll let them pay as they go if they choose to. 96, 97% of the time, the second mortgage, they're prepaid. So we don't even let the clients think that they can maybe pay the second mortgage as well as their first, and property taxes and bills and car payments and life, because obviously food's gone up too. We take all that into account, and it's like, nah, you know what? That's going to cash strap them on a monthly basis. We're going to maybe give them an extra 10 grand. Instead of being at 52 LTV, we're going to be at 53, but we're going to prepay this. So we're going to help and make sure that these clients are in a better financial position 12 months from now than they are today. So we very, very carefully monitor stuff like that. First mortgages, because it's their first mortgage, and obviously the rate that we generally do on stuff like that, the rate's lower because it's the first, not a second. and that is the first. They don't have another one. If the clients can prove the ability cash flow wise, whether they're self-employed or employed, if they show the ability that they can make the payments based on cash flow and it's not cash strapped them, then we'll allow them to do so. But for the seconds, generally speaking, almost never do we allow the client to pay as you go. Almost always it's prepaid. And that's our first thought, and I said this many times, our first priority is with this fund is our investors. It's not the borrowers, it's the investors, which is us too. It's us, it's our family members, aunts, uncles, grandparents, cousins, nieces, nephews, you name it. So we look after our fund money, whether it's ours or yours, like it's ours, because obviously we have a big stake in it as well. So we're not going to put the fund at risk or our investors at risk for the sake of letting someone that probably has no business pay as you go. It's like, well, here's the deal, and if you don't like it, well, then we can't help you. We don't let the client dictate terms; we dictate terms. So, very, very prudent in staying on top of that to protect the integrity of the portfolio for sure.
I appreciate you, and I know the investors on this call appreciate you sharing with us that even your own family money and your own personal money is involved. It's one of the things we look for at PANGEA is management personally vested or connected with their own assets in any of the investments that we participated in. So that is a significant vote of confidence. I wanted to pick up on one thing you talked about just previously. You talked about second mortgages. And I know you're driving, so please keep your eyes safely on the road. But the folks attending this call can see up on screen the fact sheet that you sent out earlier this year in January 2022. I'm sure we can get the new one from Q1 out to us momentarily. But I wanted to quote some of the information there and just have you give us an update maybe from what you've seen recently. You said in this fun fact sheet that the annual volume increase from this, and I'm reading it directly here, in January 22 was over 35%. Are we still seeing those sort of volumes now as we get into Q2?
Yeah, and that's why I said is early on the call, we've had record, like March and April have been record months for us. With volume and origination, and we don't see obviously that slowing down. As I said, even our CIBC business, we've had back-to-back record months, and next month, based on pipeline, is going to be 3 months in a row. So yeah, the amount of business out there has been substantive for us, and again, we've added collection agencies. And we're now actually going after banks directly. We're in deep conversations with 2 of the big 5. So instead of sending them their paper off to these collection agencies where they obviously get pennies on the dollar, because once they send them off, they basically write it off. So instead of doing that, we're going to deal with them directly. So as I said, we're in deep discussions with 2 of the big FIs to get their collection business, both because we obviously have the unsecured side and the secured side, which is what we're talking about now. But we're, as I said, deep discussions to get that business direct from the banks so that they're not sending it out to third parties. So instead of getting pennies on the dollar, maybe they get 50, 60 cents on the dollar versus 10 or 15 cents on the dollar. Well, when you think about how much business a bank does between credit cards, lines of credit, unsecured, etc., that's a lot of money for the big banks that's now staying in their pockets. But still, again, rehabbing clients that they have first mortgages with, instead of basically writing them off and they're eventually going to lose that first mortgage, now we can take that collection debt, consolidate it, get them paid in full on their stuff, and then in 12 months, they're likely more apt to now take that client back because they were able to salvage that credit card or salvage that unsecured line of credit and not write it off. Whereas we all know if you write off a credit card with a bank and you want to get borrowing from them again, good luck. It's not going to happen. Where if they're made whole and it's basically a blip on the radar, because the banks don't care if you go through a divorce or lose your job or whatever, you write them off, you're done. Where this gives that client the opportunity to now stay with that FI. And that bank doesn't lose that business, because obviously there might be investments in other credit facilities or lending products that they have with that client that they don't want to lose that client. It's a lot easier to maintain an existing client than it is to go get a new one. And that's where we come into play. And as I said, we've done that for almost 5 years now with CIBC. We're a great retention center for them. Over 90% of their clients after 12 months are able to get refied and blend our mortgage back in with their first. That's a pretty big number. So that's some of the stuff that we're working on. And as I said, we've deepened. Can't remember names off the top of my head, but we've seen many mix in the last couple of years go under because of a lack of business. And I've slated before, instead of us sort of holding on to what we had and okay, well, hopefully the boat doesn't get rocked too much. No, everyone else is floundering. This is the time to thrive. Let's go out, knock on doors, hire people, and penetrate the market even more than we have already. And that's what we've done. And we're seeing the fruits of that labor now with the record number of deals we're doing. Generally speaking, early to mid-month, we see a dip in fundings. It's almost like month end, which is this week. It's very busy. It's almost been like month end every week for the last 2 months, which is stuff that we have never seen before. But again, that's the kudos to our sales reps and sales managers doing their job. They're out there working hard, and you can see it. Our numbers don't lie. People do, but numbers don't. As I said, we're doing very well right now.
Yeah, indeed. And we're seeing the performance and are happy to celebrate it with you. I would like to just take a momentary pause to invite the listeners on this call. If you are familiar with the Zoom platform, the interface, look for that chat button and feel free to enter any of your questions or comments into the chat, and I'll be happy to read them to Matt and provide the commentary to Matt as well while we get into the latter part of this conversation. Feel free to use your chat to send any comments or questions, and I'll be happy to ask them for you. Matt, coming back to our conversation now, I wanted to talk about the portfolio itself, and managing risk is always top of mind for us and doing so effectively. And I know Jackie has a question here. Jackie, I saw that. Thank you. I'll ask it in one moment. The portfolio, reading from the fund fact sheet, your most recently available one, according to the security position, 82% of your mortgages are in second mortgages, 12% in first, and 6% in third mortgages. Are you, what's your sentiment on that slice of the third mortgages pie increasing over the course of 2022 in the coming quarters?
It's not very high. The biggest reason why is obviously if there's a first mortgage on a property, and then there's a second put behind it, it's going to be a private, because another bank is not going to go behind another bank in second position. Mm-hmm. And our fund is not allowed to go behind a private. Mm-hmm. So where you're seeing some of those thirds come into play, which really aren't thirds, is where the bank has two registers against the property. They've got a mortgage registered, and they've got a second secured line of credit against the property registered. So theoretically, we're in third position based on that, but we're actually in second position because the line of credit's actually tied to the first mortgage to a degree. So they're both combined. As I said, it is registered as a third, but it's really not a third. It's just the bank, because most banks, if you've got a home line plan like Royal Bank, you've got a mortgage and a line of credit, and they're merged together. You might have 700,000, mortgage is 500, but you've got access to a line of credit for 700 total. But some banks like TD, for example, most times they register them separately. You've got a $500K mortgage plus a $200,000 line of credit on $1 million house, and they needed $100,000. So in theory, it looks like a third, but it's really not, because again, we cannot go behind a private mortgage. So when it says a third, it is, but it isn't.
Yeah, the distinction is very important for us from a risk management perspective, and you know this as well as everyone likely on this call, that the thirds generally in the traditional sense of a third would be generally higher risk and of course attract a higher rate of return, but we're concerned about managing risk. So thank you for clarifying. Really, that it's only showing up as a third because it's behind, let's say, a big bank that has a mortgage plus a secured or homeowner line of credit on there. And that's why it's showing up there. And it's not really in the true sense of the definition a third. So thank you for that's very important for us. I wanted to turn to Jackie's question here. She asks, how much hiring are you doing for the additional business?
Lots. So actually, we're on the 15th. So we have a new office. It's literally across the street from where we are now. It's 4 times the size of the office that we currently have. They're just finishing the renovations on it, so we're slated to move there May 15th. Yeah, we're to say we're bursting at the seams. We no longer have a boardroom. We no longer theoretically have a kitchen. We have people everywhere. In the office, we like our office, like my office that I sit in with the 2 partners and our office manager, like it's the size of probably a very small bedroom in your house, and there's 4 of us in there. So our office today, it's tight, to say the least. We just added a year ago, our back office, our accounting office had 3 people. Now we have 7. So you can see how that goes. Our sales staff has basically tripled in the last 12 months. Our legal office used to be 1 lawyer and 2 law clerks. We now have 1 lawyer and 4 law clerks in there. So yeah, we have grown by quite a bit staff. I'm not going to say we've doubled in size in the last 12 months, but easily by a third. We saw it coming, so we do have office space that I think the new office can hold up to 150 people, where our current office can hold 40, even though there's probably 45 or 46 of us in there now. So we are growing, yes.
Yes. Yeah, like you said, bursting at the seams. We definitely need more space for you. The 4 of you or the 3 of you in one office is actually quite quite close quarters, I think.
It's a little too cozy at times, yes.
That's good to hear that you're growing. I wanted to just invite anyone else who's got any questions or comments to feel free to drop them into the chat box, and I'll pick them up and reflect them back to the broader group. Moving to the next question that I think would be important for us to understand as we shift to the conclusion of this conversation, Matt. I wanted to ask, in the context of the discussion we've been having about the weighting in the portfolio for mortgage types and even location. I know that based on the last fun fact sheet, that 96% of your lending is happening in Ontario, with about 4%, give or take, outside of Ontario. I wanted to understand what new strategies the FSI management team is discussing, if any, to diversify the portfolio in an attempt to further mitigate risk. For example, lending in new markets or different property types.
Yeah, so currently we're in the midst of, because we want to be, especially with CIBC, we need to be nationally. We got to be from BC to PEI, everywhere in between except for Quebec. So and because it's not our own backyard, we are starting to do a bit more business out east. We're doing a bit more business, obviously, in BC, but because we don't know this like the GTA, our loan to values out there are, I'll sub 50 for sure, but in a lot of cases, probably sub 40, even sub 30. Like I know we're funding a deal tomorrow. It's a first mortgage in Nova Scotia and the loan to value is 16%. So we are diversifying as far as spreading out across the country because we have, with the bank, we don't have a choice. We have to, even though we were lending outside, but some provinces you need to be licensed outside. Some you don't. BC, for example, we had done a few deals there. Then we found out from their board, no, you got to be licensed to lend here. So now we're in the final stages of getting that done. So we basically got a warning there. But again, we didn't do it on purpose. Most of the provinces, you don't need it. But we are, as I said, we still don't get away from the family home. Do we do some rental properties? Yeah, we do. Do we do a lot of them? No, because based on stats that we've looked at, because Harry and Alex have been doing this almost 20 years with the company, people that have a wife and kids, they need to keep a roof over their head. So they're more apt to pay their mortgages than a single guy or a single girl or a rental property that they're looking to pull equity out and blah, blah, and then something goes sideways, there's a flood and they didn't have insurance and they got to walk away from those. We stay away from deals that could potentially be problematic. So as far as diversification goes, by province, we're going to be diversifying a little bit more, but conservatively. But our strategy and what's been successful for us, that's not going to change. So the property type being primarily the family principal residence, that's what we do. We don't look at, oh, this guy's got 6 rental properties, can you do 7 and 8? No, that doesn't interest us. And if someone does have a primary residence and a couple of rentals and they want to do a third one, no problem. We're going to tag your primary as well. We'll finance your third mortgage property for you, but we're also going to take your primary as. Why? Well, that's going to give you incentive that if you default over here, well, now your primary residence is at risk. So again, we're very strategic in what we do and how we do it and what we deem as to be successful. And the fact that our portfolio deficiency is virtually 0, that speaks to that volume loud and clear. Our delinquency rate is lower than the big banks. And there's not too many privates out there that can say that.
That's a powerful record to continue to hold and to be able to manage as you scale. You know this because you've been around business and you were at one point in your career at RBC. You know, as you scale, maintaining that risk profile, it becomes a bit tenuous. And those are the things we know at PANGEA we want to keep an eye on, is that we know your team is capable and scaling is possible. You have the capacity, and we just want to make sure we encourage you to have the right risk management framework in place to manage all that growth. And this is what's leading me to ask this question next, which is around structural changes, Matt. We'd like to learn about the structural changes happening at FSI that will continually position you for success in the coming quarters. You've already mentioned the growing team. You've mentioned the wonderful relationships with the big banks that you're discussing, 2 of them right now, to take on some of their business and scaling across the country. Those are exciting things. I wondered about additional structural changes, like when the management team sees this, let's call it this abundance of additional business. Are we starting to talk about carving off different funds for different profiles of properties and geographies, just to isolate the risk, if you will, in separate types of funds? Is that on the table yet for discussion?
Yes and no. So one thing to keep in mind with the fund that we do have, so the portfolio that we manage, the individual aspect of the portfolio we manage is about 5 times the size of the funds that we currently have. So there's a lot of business that we still have individuals do for us because we don't have enough money in the funds to do it yet. Mm-hmm. So as much as we're successful within the fund, we're just as successful on the deals we do outside of it. So the investors that we've had, some for almost 20 years, every investor we've ever had on any mortgage we've ever done has been paid in full on every deal they've ever done. We've never had an investor lend us money to lend to a borrower at a 10% interest at $100,000, and at the end of those 12 months, he didn't get the $10,000 that he was owed on that file. We've never once had an investor get shortchanged a penny. So as much as the company continues to grow and get bigger, as the fund continues to grow and get bigger, our reliability on individuals is going to become less and less, and hopefully at some point almost non-existent. But do we have diversification in the funds? Yes. Our RBC fund is through Dominion Securities is live. The rate of return on that fund is 8%. So that fund at that rate of return, what it allows us to do is first mortgages. Because obviously even in the private, we can't be doing first mortgages at 10%. You won't get a lot of business doing so unless you're going to go to the absolute middle of nowhere across the country and do houses in the middle of nowhere. And that's not the type of business we want to really be involved in either. So at least at 8% money, that gets us in the door. CIBC primarily too, first mortgages, 8%, that competes with who we need to compete against in order to get a lion's share of that business. And the fact that they're open
because obviously the company, we live off of fees. If someone wants to pay us out in a month or 2 months or 3 months and we get the money back and can lend it back out, we're all for that. We're a lot of other privates, because they have money sitting around. They lock those clients in for 12 months. And yeah, our rate might be a little bit higher. They may offer 6.95, we're at 7.95, but the fact that they can get out in 3 months with no penalty, that's how we win that business. So we do have the diversity of the funds at the 8% and 10%. One through obviously our own fund, and the other one through Royal Bank. And again, that's something that we've only funded a handful of deals so far, because we just literally got that money live. But now that money's coming in steadily, so that portfolio is going to grow very quickly as well. And again, our goal is to never have to call an investor saying, hey, we've got a deal here in Hamilton at 60 loan to value. We need 200 grand. Are you interested in doing it? Yes, no. Okay. If he says no, got to move on to the next one. That's very time consuming. When we have the funds, we look at a deal. Hey, 60 LTV, Hamilton, 200 grand, second, $1 million house. They got a 400K first, 200K to 60 LTV, prepaid. Yeah, it looks good. Appraisal's nice. Let's get it done. We don't have to call anybody. We make that internal decision ourselves. And obviously, the bigger you get, speed matters. And when we're not having to call people on every single transaction to say, hey, we got this deal, we got that deal, and have to explain it to them, give them the appraisal, that takes time. Versus if we underwrite it instantaneously, we can come up with a decision in 10 minutes and not have to wait for an investor to get back to us in 24 to 48 hours.
No, that's brilliant. I appreciate the efficiency of in-house decision making with professionals that have decades of experience and have, once again, skin in the game. Like, you would only make those decisions if they're, of course, benefiting the fund and your own family investment in the fund. We're just at 8:09 p.m. here on my clock. I know we've got a few more minutes before we wrap up. Till 8:15 is when we have you for. I'd just like to invite anyone on the call who has any questions or even comments, or if you'd like to draw from Matt's expertise while we have him on the call, feel free to drop the information, question, or comment in the chat box, and I'll be happy to read it back to Matt as I moderate the call with him. Matt, as we look to closing off the call, and before we extend our thanks to you, would love to have you leave us with any 3 sentiments that you see that are important for us to be aware of as we look into the coming 2 quarters, considering the shifting interest rate environment and any changes that you may even see in the real estate market from your on the ground perspective that will impact our holdings at FSI, or even invite further contributions if you see that there may be a need or an opportunity for us to participate in additional deals you have in the pipeline. I'd love to hear your comments.
Yeah, no, I said obviously with the rate hike that has already taken place and the stuff that's likely to continue to happen, the market obviously is something that we monitor daily. If something's on the news or gets posted somewhere, we have a lot of us are looking and monitoring that on a daily basis to make sure that we stay on top of stuff like that. Because if we see that the average, I don't know what the average price in the country or GTA is, I think it's around $1 million. But if you see that average starting to go down, okay, well, that's a problem. That tells us, or that triggers to us, okay, you know what? We got to start lowering the stuff we're putting in the fund. Instead of going up to 65, 70, well, now we're going to go up to 60, 65. We'll adjust accordingly to offset what's happening in the marketplace. We want to make sure our loan to value on the whole is around 60%, 61, 62. Right now it's sitting at 58. That's our split. That's where we're comfortable, where we can put ourselves against other mix out there, risk mitigation. Okay, well, at 60 LTV, we're offering a 10% rate of return, which we're hitting. Those are numbers that make us very competitive in the marketplace, but it also, more importantly, makes the investor's investment as about as secured as it gets. There's a lot of these mix obviously out there that are 70, 75 LTV offering a 10% rate of return. Well, I know I'd rather have my money at 60 LTV than 75 with the same rate of return, because that risk is obviously a lot higher than what ours looks like. So that's something we're going to continue to monitor. We're obviously coming into the spring market, which is the busiest time of year for house sales typically.
Mhm.
So the next month or two is going to be a big telltale of what's the market going to look like coming into the summer and fall. If the price houses dip a bit in the spring market when it's usually at its peak, though that's a trigger to us that come July, August, September, the house prices are probably going to dip even further if that's the trend from the spring market, because obviously the last few years the spring market has been crazy, and then the summer and the fall sort of have followed suit. Where this year I think we're expecting potentially a little bit of a steady line for the most part, where we're not going to see the 10-15% increases we have over the last few years. We think we're going to see a bit of a flat line finally, which is probably long overdue.
Indeed. Matt, I want to say thanks very much for your time this evening. We appreciate the team at FSI. We've got some comments from Jackie here saying thanks very much and appreciate your insights. Thanks for doing such a great job. That's encouraging to hear back from our PANGEA investors. We appreciate the team at FSI, and we appreciate you sharing part of your evening with us, even though you're taking care of your family, and making time for us this evening means a lot to us. And we look forward to connecting in the coming months to hear the wonderful progress and to celebrating more successes with you. Matt, thanks again for joining us for our PANGEA Investment Manager Update.
Not a problem. Appreciate it, Declan. And as always, if anyone has any comments or anything, they can always call me or email me, and I can discuss anything further, even off of this call.
Thanks very much there. We look forward to being in contact with you. Bye-bye for now, Matt.
Awesome. Thanks, everyone.
Thanks, everyone. Have a good night. Bye-bye now.